Broadcasting live from the Business RadioX studios in Phoenix, Arizona, it's time for Phoenix Business Radio, spotlighting the city's best businesses and the people who lead them.
Welcome to the Mind, Money, Motion program, where we focus on worrying less about money by keeping our mind and body healthy. I am your host, Marie Burns, a certified financial planner, speaker, author, and founder of the education business called Mind, Money, Motion. My guests will help you improve your mind, or your money, or your motion, all so you can enjoy less worry and more life. I do want to thank my co-sponsor, the Women's Enterprise Foundation, for helping to make this program possible. They are a charitable organization that supports and inspires women business owners because they believe that women are the glue for their communities, which is why the Women's Enterprise Foundation offers grants and scholarships to assist women business owners in the Phoenix area. I'm excited to welcome my guests today. It's the beginning of the year, so taxes are beginning to be on the brain. So today we have joining us Angela Sticca Snyder, CPA, who considers herself the consummate cash strategist. She's also the author of Expensive Business Mistakes to Avoid and a frequent guest on a list of television stations too long to even read. Her talents lie in taxation, accounting, business consulting, organization, and creating peace of mind out of chaos. With over 29 years of experience, owns and operates a firm in Mesa. I'm welcoming Angela Sticca Snyder from her firm, the Taxanista. Welcome, Angela.
Hi, thanks so much for having me. Looking forward to talking tax.
Well, I know that that is not common for most people, that they enjoy the topic. So I'm curious how this became a passion or an interest for you and helped you get to where you are today.
Yeah, I'm that person that always knew what she wanted to do. So I always loved numbers. I always loved business, even as a kid when I didn't know what it was. So I would have little sales with other kids in the neighborhood. I would inventory my Halloween candy and literally create these little tally sheets and then have a sale, like a shop. And I had such enjoyment out of balancing it. And it was just, it sounds ridiculous, but I really enjoyed it. And so I went off and got my bachelor's degree in accounting at the age of 19. And then I took a year off, went to culinary school because I was a little burnout at that point because I had been in school. And I realized, no, that's a lot harder.
Cooking, being a chef? What?
Well, I worked for a caterer, and I actually went to the university for a year in culinary. So it's serious stuff, It's not just throwing it all in. So I enjoyed it, but it wasn't for me. And so I went back and got my master's degree in taxation at the age of 21. Because taxes are not black or white. We like to say that there's this great big pink area in the middle that you can be creative because some things are black and white, but there's a lot that isn't. Mm-hmm. So it's fun to I get my creative side out there in strategic planning.
Well, that's awesome. And you sound to me like you have strength in your left and your right side of the brain because, and I don't want to make this sound, well, it is a little stereotypical. You think of CPA, a lot of times CPAs get maybe incorrectly lumped into another bean counter kind of person. Someone, like you said, that's very good at math, loves to work with numbers, but would really most of the time be just as happy sitting with their computer in a corner, never bothered by a human being.
Right.
So you are a little unique in that because you are also, from my observation, I've seen you speak and present and interact with other folks. You love people. And so when I read in your bio that you're the consummate cash strategist, I thought, okay, that takes communication with a person. And so you like the numbers in your head, but then you also enjoy the people part too.
Absolutely, I do. And when I say the consummate cash strategist, well, I grew up in Sarasota, Florida, where you either were extremely wealthy or you were extremely poor. And we were extremely poor. And so that was my motivator because I never felt like I was missing anything, but I knew there was more out there. And so when you have no cash, that becomes your focus. And so now, even when I don't have the same financial concerns I did in the past, I didn't bring that baggage with me. I learned how to get past it in order to grow, because a lot of people have this money block that they can only go so far, or they feel guilty, or there's so much psychology around it that I like to try and help people get through that, you are deserving, you do deserve it, and you have earned it. So
you bring up a common theme in our Mind, Money, Motion program. Yes. And we've talked about this several times in the past. The whole mind aspect has such an impact on the money aspect. Yes. First of all, the overall premise is a healthy mind and body costs you less, so you have to worry less about money. But there's a lot more to that. And when you talk about growing up, and I hear this from a lot of adults, a lot grew up either lower income or lower middle income, but really had no clue. As a kid, we didn't feel like we didn't have anything. Money was kind of not really in our vocabulary, but we felt things that carry with us into adulthood. And they say that our thermostat, our relationship thermostat overall, whether it's a relationship with money or food or people, is set by the time we're about 6 or 7 years old, because our brain is just not physiologically capable of filtering anything. It just absorbs. So whatever we heard or felt or saw around us impacts us. But you have made it a point to overcome any negatives, the whole mindset of, I don't have money. And what you think about becomes reality. So you need to shift that mindset of, I don't have money. No, I enjoy money. I use money as a tool. It is not the means in itself. It's not the end goal. It's the tool that gets you to what you really want. But for you to recognize that, again, as a CPA, sorry CPAs out there, but the people side is often not their primary passion.
That's right. Yeah. I sometimes say, I should have gotten, or with an accounting and tax degree, you should have at least a minor in psychology because when people come into the office, they're so intimidated. I mean, our office is not like your typical, so it's not very intimidating, but they're afraid. They feel like they're the only one that doesn't know, or that's behind, or that's lost. I see people break down, because it's so overwhelming, especially if it's a husband and wife, and either they get divorced or somebody passes away. That's usually a very traumatic experience for them to have to deal with something they've never had to deal with.
Absolutely, it is. And that whole couple, situation, when we're married, we end up having our little departments. My husband is all things mechanical. So the vehicle or house repairs, that's my husband's department. And so it's very common, even when it comes to finances, for people to get their departments. A lot of times it's either the wife take cares of it all or the husband take cares of it all, but there's oftentimes not a sharing of responsibilities. And I've shared this on the program in the past, but I think it bears repeating. There's studies about everything, right? So one study that I totally see as true in my practice in financial planning with clients is there are typically 3 different types of couples. One is the driver and passenger couple. That's the one where I'll use my parents as the example. My father took care of, and it's very commonly the man, but not always, took care of everything financial. And my mother was the passenger, and very similar to many couples, she was thrilled to be the passenger, glad she didn't have to worry about or take care of any of those things. Knew nothing and was glad she didn't have to know anything. So that's the driver and passenger couple. Then there's the joined at the hip couple, where they talk about everything financial, so they're both aware, but one of them is still really the doer. One acts on, makes the phone calls, fills out the paperwork, does all the transactions. So joined at the hip knows, but still one is the doing. And the final and third couple is the divide and conquer couple. They not only talk about everything, then they split the duties. So my husband and I, ironically, this occurred before this is my second career. For almost 15 years, I was a registered dietitian.
Mm-hmm.
So I tease my clients. I used to help people balance their diet and exercise. And now for the last 20 years, my business minor kicked in, and I have been helping people balance their finances instead as a certified financial planner. But before, I think this evolved in our marriage even before I shifted careers. I take care of the investments and the insurance, and my husband takes care of the banking and the bill paying.
Mm-hmm.
So truly divide and conquer. So just like you mentioned, when someone loses a spouse through death or divorce, whichever one has not been used to doing the financial stuff, talking about it but not doing it, or not doing all of it, it can be absolutely overwhelming.
Yeah. And you know what? Since we're talking about potentially if somebody was divorced, that's one of the things that changed with the tax law changes. Is that okay if I mention that now?
Yes, please. Yes.
All right. So in the past, if you were divorced before December 31st, 17? Sorry, I'm like, what year are we in? Because effective in 18, if you got divorced, then you don't get to deduct the alimony as a deduction from your income if you're paying it. But then on the flip side, the recipient does not also have to pick it up as income. Okay? I don't really agree with that personally, because the person that's paying the alimony is paying the tax on it also.
Mm-hmm.
You know? So unfortunately, that's the case. So anybody now that comes to us, you actually have to put in the date of the divorce as part of it. So for the recipient, it's great. For the payer, not so much. So
yes, yeah. And you're right. We're going to talk about what are the newer things. And that was one thing. I did some bookkeeping in high school. I actually thought about becoming a CPA. I love the bookkeeping side of things, everything tied out. And until then, I realized how thick the tax law book was. Of course, now it's all electronic. And then they keep changing the laws, haven't they? You've been doing this for almost 30 years. So
actually, that's 30 now. I need to update that.
It seems like they're changing the laws more frequently than they have in the past as well. Or are we just more aware?
No, I think we're more aware of it. The
Okay.
largest changes that have occurred was the one in, I think it was 1985, right? 85. And then the one that just occurred. So those are the largest sweeping changes, yes. And they do go back and forth, deciding whether they're going to extend this or continue it on, things that are only on for, let's say they only extend it, Congress only extends it for the year, and then they have to meet each year. So I think they just talk about it more, I think.
I think it's become more political, so that
I think
helps
that could
the talking
be it too.
side of things.
Yeah.
Well, so even through the tax law changes, just knowing human nature like you do, would you say there's always kind of some typical things that are confusing or trip people up, or you see common mistakes time and time again?
Okay. This is the most common misconception. And I can't wait. I'm going to be posting a survey out on Facebook, and it's going to be shocking how many people. For your listening, would you rather be, which tax bracket do you want to be in? The 0, the 15, or the 33? Okay. And I'm just picking numbers. Okay. So I don't even think there's a 15 and a 33. I think it's 32. Anyway, which one do you want to be in? I don't know about you, but I want to be in that 30. I want to be in the highest tax bracket there is. I want to pay and be in the highest bracket there is. Okay. Because if you're in the 0%, guess what? You're unemployed.
All right. That means you have not much
income.
You have
nothing. Right? So people will say, I don't want to go in the next tax bracket. I don't want to go in the next tax bracket, and that tells me they have no idea how the brackets work.
Yes.
Okay. And I'm going to use a gross example. This is definitely not correct. Okay. This is just an example so that you'll understand. So the way they work is, let's say from 0 to $10,000 of income is 0% interest, 0% tax rate. $10,001 to $100,000, let's say, is at 15%. And $100,001 is at 35%. Okay. And you make $101,000. Then only $999 is taxed at that highest rate. Okay. So everybody pays 0% on that first part. Everybody pays, the other percent on the other part. It's the most misunderstood concept.
You're right. I think everybody hears the highest tax bracket and thinks that applies to their total income.
Mm-mm.
But it's a tiered system. So the first X amount of dollars is at 0%. The next X amount of dollars is at 12% or whatever the brackets
12,
are each year. Good.
Yeah.
Great point.
Yeah, so you care more about what your effective rate is, not your marginal rate, because you're effectively paying a blend of them. I'm sure everybody here that's listening is sophisticated enough, and you get your taxes prepared for you. There should be a summary in there that compares year over year. Look at the bottom of it. It will show you your marginal rate and your effective rate. So your marginal rate is the highest bracket you're in, but your effective rate is usually always going to be less.
That is an excellent exercise because especially when the 2018 tax law kicked in, I kept hearing people talk about, I thought this new law was supposed to help me. I didn't get a refund this year, or I didn't get as much of a refund. And I said, well, maybe if you look at your tax rate, your effective tax rate comparing 2 years, you'll see that the percentage that you paid potentially went down, or the total amount of taxes you paid, not just the refund amount.
Yes. And it's unfortunate that people look at what comes back to them, their refund or their balance due, because that actually has nothing whatsoever to do with what really happened in that year. Okay. And what happened was, if people were looking for a larger refund, they changed the payroll tax withholding tables. So when you go to your job and you fill out, okay, I'm married in 2, single in 4, whatever it is, there's a calculation that tells the system how much tax to pull from your payroll check. Well, they adjusted them to pull less so that people would have more money in their pocket every day. And people didn't realize that. And also sometimes the media can put a spin on things that isn't quite accurate. I think we only had maybe a couple of people that ended up paying a lot more. But everybody, all of our clients experienced quite a bit reduction. So I think that's, yeah.
I think the other thing that I thought part of what you were going to say is we talk about this and people nod their head and they agree. The fact that if you're getting a refund, you let Uncle Sam hold your money longer than you did on those dollars. And is that really a wise financial way to manage your money? And people usually nod their head and say, yes, I know and I agree. But I look forward to that money for our spring break vacation. Or so they're really kind of using it as a forced savings.
Correct.
Knowing that then will come back to them at another time.
Right.
So.
Yeah, that's one thing we like to get to know right away is people's personality.
Sure.
Because some people don't want to pay anything all year long, and then boom, they just pay it. Okay. Not advisable. And then other people like to get a huge refund, and it's just one positive thing. Okay, let me give you a positive thing of overpaying. Okay. There really is technically no due date on your taxes. So, for instance, if you overpaid, you're getting a refund, don't sweat it. If you don't file by April 15th, if you forget an extension, don't worry, because when you file, you're actually going to earn interest on your refund. So it's not good interest, but it's interest. So you got to find something positive in every situation. So if you're one of those, then don't sweat it.
Well, so you mentioned extensions. Talk to me a little bit about extensions. And I have seen clients feel adamant both ways about absolutely not, I don't want to file an extension versus yes, an extension makes sense. We have more time to figure things out and make sure that we have, all of the things appropriate in the return, etc.
Okay, misconception number 2. An extension is only an extension of time to file. It is never an extension of time to pay. Mm-hmm. Okay.
Yep.
People will typically forget that or not know that. So that's one thing to keep in mind. Now that everything's done electronically, I don't think that it is has as much impact on filing an extension nowadays. Because in the past, people would say that, there used to be some school of thought that extended returns had a less likely chance of being audited. But now everything's all electronic. It goes through. So I don't really think that's the case anymore.
So with audits, am I correct in understanding that the percentage of audits, first of all, in general, is quite low, but they have different percentages for different types of returns?
Yes.
And then don't they have almost, they meaning the IRS, themes identified each year that they are going to hone in on a little bit more because they've seen more issues in certain areas?
Yes, that is very, very accurate.
Mm-hmm.
So the bad thing is that I don't know how many, but I know the IRS just hired a lot of new people. So that's not so good. But yes, they typically do look at different buckets of people. And I wish I would have known this. I would have loved to have gotten the statistics on that before our chat. But typically speaking, the 1-2%ers, the more income on your return, the more gross income, you're typically going to be in a much higher risk because the more income you have, the more complexities you usually have. Not always, but typically with somebody that's a really high wage earner is going to have a lot of investments. They're going to probably do stock sales. They might have, so there's just going to be, they might have other properties. There's more things to look at than a husband and wife with a combined income of $80,000 with a house and 2 kids.
Right.
So I would say typically it is the higher income individuals and the business returns. I remember my tax manager mentioning this. I don't know if this is the focus now for this year, but 1099s are very hot with the IRS right now. Think of it this way. Nobody likes, it's more on the business side, but it's more of being the payer is the police or the employer ensuring that the recipient is getting the documentation they need in order to file their taxes.
Sure.
Sure.
That makes sense. And now you did mention businesses. I know there are a variety of different versions that a business can have, if it's a C Corp, an S Corp, an LLC, et cetera. But that makes up a bulk of your client base as well. You're advising businesses, and I would imagine different business structures perhaps are more prone to different types of audits or different focuses on audits.
Yes, a lot of people don't realize this, but there are certain cells on the tax return that connect with other data that the IRS is expecting to see. So if you put something into this, I'm not going to, in a consultant cell, and you file no 1099s, that's a problem. Okay, so there's some matching systems that go on that most people wouldn't even think of. They'd be like, really? Oh my gosh, I had no idea. Mm-hmm. So, yeah.
Well, I remember hearing you speak once, and one of the things that I thought was a really good point, even for, you mentioned a widow who used to have a husband that did all of this, and now she's feeling totally lost. Your advice was it's still a good idea to always look at the tax return.
Yes.
You're not going to understand it all, but some things are going to make sense. And if something is missing, you might pick that up just by looking at categories and without actually having to know and understand all the technical details.
Right. Just because it is in very basic English, just look at the words, wages, interest, if it says something on there, everybody can make mistakes, even if you're doing it yourself. All right. So just look at it for common sense stuff. It's like getting your EOB back from medical. Okay. And it says, benign cyst on this. And you're like, oh, I didn't know that. And they just put a code in there and it was an error. So you don't know. Right. So just look at it, even though you're not a doctor looking at those things. So just look at stuff for common sense.
I'll give an example, a personal example. And I'm pretty comfortable with taxes. But I don't give tax advice, but I do look things over. And one thing that jumped out at me was in just looking at the total amount of state taxes that had been withheld from the employer income. And it seemed really low to me because I had remembered what the state tax withholding was on one particular W-2 reporting the income. And the total was less than that one W-2. So I went back and it turned out that the software, the data entry, wherever it was, the state tax withholding on that one employer did not get picked up and input into the tax return at all.
Yeah.
So once that was fixed, voila, we did not owe the big bill that triggered me to look at it closer.
Yeah.
Place.
That's good. That's very good.
So now I keep hearing about the new W-4. Is there a different format or different information or?
Okay. Yeah, there is a new W-4 and it's very involved because it does what it should do. Okay. Which is what we do when we do tax planning for clients. It looks at what I like to call ghost income, which is your specialty. So people get paid out dividends. They may sell something and have some capital gains, things that you don't know about throughout the year. Okay, until you get your year-end statement. So it asks things like that. It asks things on your spouse. Do you have a side business? So it goes through a lot of questions. The IRS does have a good little calculator that I recommend for somebody has the patience to sit down and do that. We do assist clients. Unfortunately, we are charging them this year because it's so detail oriented. Sure. I think it's only $50 or something, but $50 or $75. But the IRS calculator is really good and would help, I would say, 75% of the people.
Oh, wow.
Yeah. So I would recommend going there and checking that out.
Now, I understand, just because I saw this, I think, advertised somewhere recently, that IRS also has an 800 number. And when I saw that, I thought, whoa, I wonder how long you have to wait on hold. I would think they would be bombarded at this time of year. And I don't know if that's anything you've heard clients have. Of course, if somebody has a CPA, they're usually calling their CPA.
Right.
And asking those questions versus calling or looking online.
Yeah. Well, you can call. I mean, they've got several different numbers for different stuff. But calling, it could be, I just say call as early as you can in the morning because you could be lucky and only wait for an hour, or it could be 6 hours and then the call drops.
No, thank you. Not a good way to start the day.
Right. Right.
So I know another, just in attending continuing ed and presenting myself or hearing other presenters, the whole terminology, I should say, of a tax deduction versus a tax credit. And in Arizona, we are blessed. We moved here from Wisconsin about almost 9 years ago. The whole tax credit thing was not nearly as robust as it is here in Arizona from the state tax credit standpoint. So talk to us a little bit about the difference between a deduction and a credit, and again, some of those common misunderstandings and clarifications.
Yes. So a deduction is a reduction of your income. So a deduction would be like your itemized deductions. For instance, medical, charitable contributions, your mortgage interest, those are deductions. A credit is a dollar for dollar reduction of your tax. Okay. So a tax credit, let's say a child tax credit, comes off of the tax that's owed. So it's as if the IRS is paying that tax for you. Well, that's not a good example because they're not, but you get it off of yours. So yeah. Now, you think that explains that and
yes,
easy to understand?
So it's the difference in, are you reducing the income or the tax directly? Because reducing the income does typically reduce the tax, but it's not a dollar for dollar tax reduction.
Correct.
Like a credit would
be.
Be.
So obviously a tax credit is way better than a deduction, okay? In the state of Arizona, we do have a lot of state tax credits that are actually legal double dips. Gotta love those. So it is a tax credit to Arizona, and it's a tax deduction on the IRS. Okay? So it makes absolutely no sense for somebody to not do this. Okay. So, and I'm going to use easy numbers. The total of all of the Arizona tax credits, it's a little over $4,000 for married and then about half for a single head of household. You make there's technically five, but there's different tax credits within Arizona. There's the public school, private school, foster care, and qualifying charities. There's also the military relief. And that one just fills up early in the year. So definitely check those out. But you can actually write your check out to qualified organizations. There's lists on Arizona.gov website. You can just Google Arizona tax credits and only go to the Arizona.gov site. And it has PDF links where you can click to make sure, because just because somebody was a qualifying last year doesn't mean that they're qualifying this year.
Right.
Okay?
I've seen that happen.
Yeah. You write the checks out to them instead of the state of Arizona. So let's say we do your taxes and you're getting a $500 refund from Arizona. Okay. But your total tax liability is $5,000, but you had $5,500 withheld. And so now you're getting a $500 refund. Your total liability of that $5,500 is the pool that you can use. So let's say you're already paid in, you're getting a refund. You can still go find these charities, write the checks, give it to your tax person. They put it on your tax return and you get that money back on your taxes. Mm-hmm. So it is a win-win. It's a win-win. Then you use those because those are donations, because they're qualified charities. They go onto your federal return. So for easiness sake, if you did $4,000 and your tax rate is 25%, which there's not a 25% bracket right now, but 25%, then you would have just saved $1,000 off of your federal taxes by making these donations. You would have earned $1,000.
Right. Yeah. And I like how you put it before. It doesn't make sense not to be doing this.
And you can do it all the way up until April 15th. So if you're tight on cash, what you can do is you can get your taxes done, look at either your balance due if you just want to do that, or, decide what you want to do. Put it on a credit card, get it done, get your taxes filed, and you might even get your refund back. If you're getting a refund, your refund back before your credit card bill's due.
There you go. There you go. I think the one thing that falls under the common misconceptions as we're talking about this too is the ability to deduct on the federal.
Yeah.
Only if you itemize.
Yes. So you only get that extra benefit if you itemize. So if you don't itemize, you still get the same benefit of deciding where you want your money to go. However, if you do itemize, you get an extra little perk.
Right.
So.
And that just changed, in 18, that whole only if you itemize, because they changed the standard deductions to be so much higher.
Right. Which is really nice. So, rather have the double of standard deduction and just miss the federal,
Right.
But yeah.
So overall, have you seen a majority of clients personally not itemizing and just going with the standard deduction?
Married couples, I see still itemizing, because even though it's $24,000, if they're both working, then it's shockingly, between mortgage interest, real estate taxes,
it adds up.
It adds up.
Sure.
So maybe a head of household or a single, I might not as much, but it's not always income driven, more of maybe where they are in their life.
Okay, great. Well, I know one of the things that I end up helping folks with, because I do investment management as part of my planning practice. Mm-hmm. And so it's amazing how when someone turns 70 and a half, the first sentence that comes out of their mouth always is, how in the heck did I get to be 70 and a half already?
Yeah.
But the reason we're talking about it is because of the required minimum distributions that they now have to take out of their IRAs or 401k employer plans. Mm-hmm. So that is a change now with this new Secure Act law that came through, that instead of 70 and a half being the magic age, which I always wondered, how did they come up with that number, has now been extended to age 72. So the confusing part there, and I'm feeling like this new law is a little bit like the tax law change, where I talk to CPAs where the full disclosure and clarification of the original law wasn't even fully disclosed to the CPAs until like September of that year.
Yeah.
So I think there's going to be a little bit of that clarification going on with the Secure Act, especially in regard to the new required minimum distribution age and how that works, and then the change in thinking about how you designate your beneficiaries, because they're changing that ability to stretch a beneficiary to be able to stretch their distributions over their lifetime. But the new RMD, required minimum distribution, my understanding, is in the year you turn 72 is typically the year that you would start taking your required distribution. They do give you until April 1st of the following year, just like they did with the last law, to take that first distribution. But just like now, most people take it within the year they turn, 70 and a half, now 72. Otherwise, you get hit with 2 RMDs in that next year. So the confusion so far that I've heard in these discussions is the new law really only applies to someone who turned 70 and a half this year in 2020 or later. So if somebody turned 70 and a half last year and they were just, that started them on being required to use an RMD, and even if they didn't take it, they were planning to take it till April of this year, they still have to take that. They are grandfathered into the old law. So that was a little point of confusion. But the other piece that comes into my conversations with clients when we're talking about their required minimum distribution is the qualified charitable distribution, where they can send some or all or even more than their required minimum distribution directly from their IRA to a charity. And that amount then is not reported as taxable income.
Right. Yeah, because they may be, if they're not aware of this, they may be taking a draw, taking the distribution, paying the tax, and then donating.
Yes. No, let's not do that.
Let's not do that.
Yes. It's a little different mindset for them, though, to understand the conversation oftentimes, because their first instinct is, oh, great, I can send it to the charity and get a deduction. Here again, we're talking terminology. It's really not a charitable deduction. It's a reduction in the reporting of your income.
Right.
So
which is better.
Yes, which is, again, kind of a mixed up way of understanding that sometimes when you're talking with clients. But so the whole idea of really minimizing their cash flow issues of having to write a check or find what's they're going to sell or even gift stock.
Yeah.
They can do it directly from their IRA, and the portion they send to the charity is not reported as taxes.
Right.
So I have more and more clients looking at that as an option. And they can, the law, for a while, they were extending it and it was good until a certain year. And then they were grandfathering it. And now it seems like they're leaving it alone for a little while.
Yeah.
The one other confusing piece about it that I've learned is that the qualified charitable distribution still is applicable if you're 70 and a half or older. So even if your RMD is now not till 72, you can still do the qualified charitable distribution as early as 70 and a half. Isn't that confusing?
That's a disconnect. But
that's very confusing.
That's a disconnect, but
and
that's
yet it's good news for
folks. That is good news.
Because the lower your account balance, which feels backwards, the lower your account balance in your IRA, the lower your required minimum distribution will be. So if you can actually get some of that IRA value down by using a qualified charitable distribution that doesn't cost you on your taxes because it's not reportable income, that's almost another win-win.
Right. That is a great win-win.
Yeah.
Now, you mentioned something about extenders or repeal, things like that. There's 2 items that I really want to mention.
Okay, great.
Because last year they repealed, when everything was falling and crashing, the IRS allowed cancellation of debt on your primary residence. It was repealed last year in 2018. So if you did have a cancellation of debt on your primary residence, it was taxable if you were not insolvent. Okay? So but they have now retroactive allowed the exclusion from income if you do have a cancellation of debt on your home. So if you're in that situation which not many people were, that you had to claim that as income in 18, you can go back and amend 18. Okay. This one will affect more people. Mortgage insurance premiums. And that's people pay mortgage insurance premiums when you buy a house and you may not have enough money to put down. Well, they took that deduction away in 18. So, and they're usually high. Okay. So if you had mortgage insurance premiums in 18, they weren't deducted. So it's worth looking at your return because it can be amended.
So is that this year only or going forward until they change the law again?
You mean as far as being able to amend it, or the fact that these items are
that there are no deductions
until they I'm not sure if that's well, it would definitely go with the whole tax law changes that end in a few years. 2024, I believe it is.
Oh, yeah, the 2026 sunset.
2026 sunset.
Yeah.
So, but I'm not specifically positive on those, so I can't. Don't quote me on that for sure.
Okay. So many details in so many of these things. One more reason to be sure you're talking with someone who does this for a living and is able to either stay on top of it or have the resources to be confirming, because it is a lot of change.
There is a lot of change.
There's money to be saved by doing it right.
And, this is, if you file your own taxes and you use those, the software where it looks for errors and stuff, and you press that little error check button, okay, it's because some of and most of the software is pretty good for basic returns, okay? But remember, when you're pressing that error check button, what it's checking is if you answered the questions and you checked boxes you were supposed to. It doesn't know how to check if you answered it correctly, okay? So just keep that in mind.
Right, that's a good point. Computers are only as smart as they've been programmed to be. They don't, at least I should say now, because this whole AI, artificial intelligence thing is kind of getting scary, but that might change.
I know. So that could change, but right now it's really just checking, because it doesn't know. So
what about folks that, and you've probably seen this, they bring in a box of files and information and say, I'm one of those that I have back taxes or I haven't filed in X number of years. Are there some things that they could do or should be aware of in those situations?
Absolutely. And it's way more common than all your listeners would realize, okay? Excuse me. I would say in our office, we probably have 15 to 20 people at any time that are 5 to 20 years behind.
Oh, that's more than I would have guessed.
Oh, yeah. It's a very lucrative business. It's just making that first step, because and I still have clients coming in that stopped filing in the 2009 when all the crash and everything was happening. And they're coming out of the woodworks now, and we're catching up on 10 years. It's easier than you'd realize to fly below the radar. The first thing you need to do is come and talk to someone. I'd love to talk to you because, there are ways out. It is best to be strategic about it. You'd want to pull your transcripts, but once you wake up the system, then you might start getting notices. So you'd want to understand and have a plan. But basically, you can go to the irs.gov/transcript, and you'll be able to request transcripts. But if you haven't filed in a long time, it will have to be mailed, because it'll have to be mailed. And you may not even be able to pull them if you haven't filed in a long time. But the key is getting them filed, because the statute of limitations, which is the amount of time that the IRS has to come back on you, is 10 years. But from the date of filing. So if you haven't filed, that statute of limitations hasn't even started. So what would have been best is if you'd filed when you had no money, okay, and everything was falling apart, and then get into what's called, like a status where the IRS isn't hounding you, okay, for lack of a better word, but you can get into currently not collectible. You can get into a really small payment plan. So the key is getting filed right away. You want that clock started. And then it's not like they're going to come demanding. They're not going to come and take your house. They're not going to come and do all those things. Now, if you ignore them, okay, and then yes, it gets bad. But that takes a long time. You get notices for a long time. So the best thing to do is to get them filed, get on a payment plan, and just put it behind you. If you're in a situation where you have no assets, you have no equity in your house, you have no rental properties, no more retirement accounts, no more 401ks, no IRAs, nothing like that, then an offer and compromise might be an option for you. I would personally not recommend the late night commercials of people because they charge an awful lot for something they don't need to. But if you literally have no assets, there's definitely a way out.
I'm curious if there's like this overarching theme or a common denominator when you see these 15 to 20 folks a year that's their why. What was the reason they have not filed in so long? Is there a, it was the bottom fell out of the housing market and they lost everything and they just...
Yeah, it could be a death, an illness, a divorce. If they owned property back in those days, it was usually because they had a foreclosure, a bankruptcy. And then, the first year of not filing is sort of tough. The second year, they already missed the first year. It gets easier and easier and easier as each year goes by. And the IRS, there's, they will send out a notice, you didn't, we didn't see your 2018 tax return. If you look in the upper right-hand corner, each notice has a different type of code. And if it's a CP code, then it's computer generated. So it's not like the IRS, some person is over there. Oh, Jane Doe, she didn't file her 18 return. No. It's just a computer system saying, we received all these socials. We didn't get these. Spit these letters out.
Huh. So you mentioned socials, and I've heard that come up several times where, in fact, this happened to us. I don't know how many years ago. We filed our return through the CPA, and they got a message back that said, oh, this Social Security number's already been filed. A tax return's already been filed. And in thinking back, I don't remember, I'm pretty sure all they did was resubmit it, and there was an inverted number somewhere in a system that then it went through the second time. But do you see that with Social Security numbers? Is that always fraud or?
Yeah. If you get a reject and the e-file doesn't go through, I have never seen one where it's not fraud. Okay. I've seen people not know their social. I have no idea how that's possible. How do you not know your social? I've had people give me wrong socials. Okay.
Oh, I've had that happen.
Haven't you? It's the craziest thing.
It'd
be like somebody not knowing their birth date. I'm sorry, as an adult. A kid, okay, but sorry, but that's just too funny. Okay. No, it's always fraud. So you'll usually see it happen with the elderly and with kids, unfortunately. So if we file a return and it comes back and it says, the taxpayer, the individual on line 2 of the dependents has been claimed by another person. Now that may not be fraud. That could have been another spouse.
Sure. A
divorce situation. Yeah. But, if that's the case, don't try and handle that yourself. Even if you're a diehard, want to do your own taxes, completely understand. But in that case, I would go to somebody.
Yes. That sounds like good advice. Oof.
Yeah.
Well, I know one of the other things that I find confusion around is capital gains tax versus ordinary income tax.
Okay.
So the whole idea that, you sell something or you have any income coming in from any account is confusing to people that the tax owed on income from whatever source it is very much dependent upon what type of an account was it from or what was the income source. And I think the whole, and maybe it's been an evolution of the tax law, but capital gains rates are tied to, well, what is your ordinary income tax rate? And I don't know if that's how that always was, but I think that's challenging for people to understand.
Are you asking me a question or?
Well, and And maybe this is, if somebody sells stock, for example, from a taxable account.
I don't know the theory behind it, but I can give my opinion on it.
Mm-hmm.
I would think it's based on that because conceivably the person with the higher capital and qualified dividends would be somebody that's, if they have a higher amount, they would conceivably be a higher income earner.
Mm-hmm.
And that's possibly why. But definitely a lot of planning involving somebody like myself, like Taxanista, and a CFP, because you might, if you're thinking of cashing something out, or you could stack it between the years so that you're not all getting hit with it at once and pushing you into another bracket, which we talked about the brackets earlier. But if you could keep within certain brackets, you'd pay less overall.
Right. And I think the logic I remember reading once with making the capital gains tax percentages lower than some of the ordinary income tax brackets was to incent people to invest.
Oh, well, yes, absolutely.
Yeah.
I thought you were asking me, why are they aligned? But yeah, it's definitely to incentivize investment because it is, yes, because with a higher rate there, it disincentivizes, that's not a word, but it disincentivizes investment in that. Yeah, that's absolutely what it's for.
And I think part of the different types of accounts and the different percentages, capital gains versus ordinary income tax, is why, and until somebody's retired, they don't often realize, but when you're retired, it's a little trickier to be dancing around tax planning because now you have different pots to choose from as to where to draw income most tax efficiently versus your income came from a job and you paid ordinary income tax on your job.
Right.
When you were working. That was pretty straightforward. But now you might have a Roth, tax-free income. You might have a taxable account where it's capital gains tax. You might have an IRA where it's ordinary income tax. You might have an annuity. Is it a non-qualified annuity or is it a qualified annuity? So is there basis in that non-qualified annuity? You're going to owe ordinary income tax until you get to the basis and then it's tax-free? Or are you annuitizing it and there's a percentage that's taxed and a percentage that's not taxed? I mean, it gets more complicated than I think people realize once you're retired, when you think, it'll be much more simple. And it's usually backwards.
Right. It's definitely much more complicated. And then to add in the Social Security component too, because most people are shocked that you actually pay tax on Social Security.
Yes.
And I'm like, you only pay it if you have a certain amount of income. So yeah. Now, are you working with people because taxes are on sale? Are people starting to convert their traditional IRAs to Roth IRAs? Because I would think that'd be a good thing to do.
We look at the partial Roth conversion options. And of course, that's a little complicated because of the aggregated rule where if they already have, IRAs, we have to think about that as well. But, I've talked with CPAs that often feel like once you're over a certain age, how much tax deferral time do you really have left? Does it really make sense to be having Roths? And I have personally worked with folks in retirement long enough that I know myself, I'm going to be thrilled to have a tax-free bucket available to me. I don't care how many years down the road.
Yes.
So a lot of times that is a tool to help people max their tax bracket. So they're getting to the edge of the tax bracket for the year, but they still need more income, or now they need to buy a vehicle and they need to take it from an account that's going to cost them some taxes. Or if they have a Roth, we could take a withdrawal from the Roth to help purchase the vehicle as an example and still keep them in that tax bracket.
Right.
So to me, it's just another helpful tool to be potentially used in retirement.
Yeah.
So yes, 'tis the season.
Yes. And you never know. And you never know if they ever are going to repeal that. I doubt it, but
that's been another point of paranoia I used to work at an accounting firm, and I understood the CPA's point that who knows if the tax law change will occur or not. Who knows if the IRS would grandfather you if you already have a Roth and they would just say, okay, the new law applies to those going forward. We shall see, because my understanding with this Secure Act, where they're basically saying spouses, and there's a few other categories, are the only ones that it really get to stretch over their lifetime as a beneficiary for the most part, because the government needs their tax money sooner is really why they changed that law. So I think that's going to become more and more legislated as we move forward. So it's never say never, right?
Right.
So we'll hope the Roths always stay tax-free, but never say never. One last thing I wanted to ask just briefly about was, I know you work a good amount with businesses. And when folks are setting up a business, a lot of times an LLC comes into the conversation. Is there a best state to form an LLC in?
Okay, this is misconception number 3, but this goes on the business side, okay? So people tend to think that if they form their LLC in Nevada, that they're not going to pay tax. You pay the tax where the work is performed. So it doesn't matter where you form your LLC for the impact of your federal tax, okay, or your state, because it's where you're operating. Arizona's LLC is super easy and cheap. So I like that.
Two good qualities.
Two good qualities. There are other reasons why you might want to create an LLC in another state. Maybe you want anonymity. All right. You don't want anybody knowing who owns that business. And so that's why some people will go to Wyoming, Nevada, Delaware, things like that. But those are more legal reasons, not tax reasons.
Okay. Well, that's a good clarification. I've just heard that wondered out loud before by other folks. I know whenever I am visiting with guests on this program, I am listening for takeaways that I think apply to a lot of folks or would be helpful for someone to, okay, I just listened to this podcast. So now tomorrow, here's what I need to be sure that I'm doing. So I've jotted down 3 kind of key takeaways for our listeners to think about. Okay, is this something that applies to you? Is this maybe part of your I need to take action list? And I think of the word ACT as an acronym. A is which action, and I'll share 3 ideas with you. Do you feel like would apply to you that would make sense to act on? The C in the word act is to commit to doing it. And part of what helps people do that is the T, which is to tell someone else. Once you tell someone you're going to do something, you are more likely to do it. So I'm going to challenge our listeners to listen to my 3 takeaways, and then certainly you can add 2. But which of these 3 actions are applicable and would be helpful for you to commit to doing, and then who are you going to tell? So the first one is your number 1 misconception about the effective tax rate versus your marginal tax rate. So your to-do could be to go back and look at your summary page, like you suggested, from past tax returns, to look at the bottom and see what the effective, which is the blended tax rate, actually is. It might not be as bad of news as you thought, or you might see a trend where, you've been able to reduce that over time. So that's maybe one action idea. Another is the W-4 that you mentioned, which has become much more very involved. And so maybe check out the IRS calculator to help you look at that W-4 as another action item. And lastly, the whole definition of a deduction being a reduction in income versus a credit being a reduction in the actual tax. I would encourage folks to think about that legal double dip, or at least the Arizona state tax credit, as everybody should be doing that. It helps charities, and you're probably going to get some money back if you've already paid in your state taxes regardless. So to check out those Arizona state tax credits. Anything to add or to clarify there?
No, that's great. And if any of the listeners out there, if you're one of those people that's behind on your taxes, you know what? Don't be afraid. It's really, we can tackle this, we can get over it and just move past it.
And what is the best way for folks to learn about or contact you at your business?
Thank you. They could go to Taxanista. It's TAXANISTA.com. Our phone number is 1-833-TAXANISTA. And you can also Google my name, Angela Sticca Snyder, Sticca, and then Snyder. And we work with clients in all 50 states. We've even got clients in Mexico and Canada. So we'd love to help you. You can either work face-to-face. We can work over Zoom. We've got clients I've never physically met that are across the country. So, there's nowadays, location's not really a factor at all.
I think that's very true. So your physical location, your physical office is located in which suburb of Phoenix?
We're located in the Mesa. We're right on the border of Mesa Gilbert. So we look out on the Superstition Springs golf course, and it's gorgeous. It's tough to look out there while I'm sitting there working all through tax season, especially when the weather is
up from your desk.
Yes, especially when the weather is this beautiful. But yes.
But that's a great point. It almost doesn't matter where you are. Lots of times, I think with CPAs especially, folks will meet you once and then it's via phone afterwards. I know I have clients in 8 states.
Yeah.
And so between Zoom and personally seeing each other periodically, it's a lot of phone calls and Zoom meetings otherwise.
And we're a full service firm. So, if I'm not available to talk to you for something, then my tax manager would be, and there's definitely other people there that could talk to you as well.
Awesome. Well, thank you so much for being here, Angela. And thank you, listeners, for listening to this episode of Mind, Money, Motion, where we share how to worry less about money by taking care of your mind, money, and body. You can visit us at mindmoneymotion.com or find us on Facebook. Please join us next time for less worry and more life. I'm Marie Burns.